back as we wind down the earnings season. Just about two more days to go for results. It's a good time to take stock of the internals of various sectors. On our radar today is the biggest sector in the Nifty, the banking sector. It's been plagued by asset quality concerns in the past several quarters, but now it looks like that's ebbing off. There is still the odd IL&FS exposure that was a key stressed account among banks, and then there is the odd NBFC that may also come in. But it does look like finally we are seeing the first quarterly profit in the last 5 years. First, a quick roundup of what the big numbers were with Abhishek Kothari. Abhishek, tell us.
Well, the banking sector reported its first profit for the, first profit in last 5 quarters, thanks to lower slippages and better other income. The Q2 FY19 losses have been inched up slightly higher than what was reported in Q2 on account of IDFC First Bank merger. So, Bank of India and IDBI Bank have reported the highest net losses in Q3, while highest profit growth sequentially, that is quarter on quarter, was reported by SBI and Axis Bank. The key stress account amongst banks in Q3 FY19 was the IL&FS group, which was majorly recognized as NPA by the banks, barring a couple of them. So for Q4 FY19, the accounts under radar or watch will be, the ADAG group, DHFLZ, etc. Deposits are hard to come by, and majority of the private banks, if you see, their credit to deposit ratio is at 90-95%, which is at elevated levels. So bankers are expecting recovery in LCLT accounts, which will actually help them in their asset quality portfolio. Couple of records that were created in the banking sector was 3 banks came out of the prompt corrective action framework of RBI. So that is Bank of India, Oriental Bank of Commerce and Bank of Maharashtra. While IDBI Bank continues to be the worst bank in terms of reporting the highest gross NPA ratio, and the best gross NPA ratio was reported by IndusInd Bank. So how did the Q3 FY19 actually pan out for the sector? The sector reported a small profit of 363 crores, which was the first time profit in last 5 quarters. However, if you look at the PSU banks, they continue to maintain their net loss momentum for 8 quarters in a row. Private banks, on the other hand, have actually reported their highest net profit in last 6 quarters. Look at the gross NPA picture. The gross NPA of this sector in absolute value declined by 3.3% to about rupees 9.7 lakh crore. Gross NPA ratio declined by 58 basis points quarter on quarter to about 10.8%. If you look at the valuation picture, PSU banks right now are trading at less than 1 time price to book value of FY20. While on the other side, SDFC Bank and Kotak Mahindra Bank are the most valued stock in terms of valuations, while Union Bank, if you look at the top peers, is the lowest valued stock amongst the banking sector.
Okay, thank you very much for laying those numbers and the trends out, Abhishek. And with that, let's welcome our expert for the morning. Suresh Ganapathy, the banking expert from Macquarie Capital Securities, is with us in the studio. Thank you very much, Suresh, for dropping into the studio.
Pleasure.
Well, first up, the hot favourites have been the private banks.
Yep.
Even after we know that a lot of the NPAs are recognized, you don't want to, you would not place your bets on this high-valued Kotaks and HDFC banks?
No, so the relative upside is more in terms of where we actually see a better re-rating potential. So if you look at Kotak and HDFC Bank, they are almost fully valued. From a 5-year perspective, the power of compounding story will continue in them, but the greater upside would be in case of, say, an ICICI or an Axis, where the valuations are pretty cheap. And as you ride this asset quality cycle, the recovery in the asset quality cycle, clearly ICICI and Axis and some of these cheap banks, like even for that matter, Yes Bank, all of them would relatively give a better upside, at least over the course of next 12 to 18 months.
Okay. So ICICI and Axis, scope for more upsides.
Yep.
First, would we want some dangers out of the way?
Yep.
See, there is the IL&FS. One thought it was one-off. It doesn't seem to be. Yeah. There could be other over-leveraged manufacturing companies.
Yep.
Or even NBFCs that are not able to manage their books.
Yep.
So should we prepare for that kind of shocks? And also lower recoveries from IBC compared to what people expect?
Yeah, so, if you were to look at the run rate of slippages or bad asset formation over the course of last 3 years, the average number was around 5% of the loans going bad. So, it's unlikely that that kind of run rate will continue. Even if you were to look at cases like ILFS or a Dewan and stuff. What we are actually telling is that the average run rate of slippage ratio could be 2% over the course of next couple of years. That's about, Lata, 2 to 2.5 trillion rupees of assets per year. So if you assume a 2% run rate for 2 years, you're talking about 4 to 5 trillion of assets going bad. So that sufficiently covers some of these bad assets or some of these assets which are expected to turn bad. What we're arguing is the rate was running at 5%, that's going to be 2%, and therefore it's going to be relatively beneficial. As far as these IBC accounts are concerned, you'll be very surprised to know, and that's what even our report points out pretty clearly, that the coverage ratio for banks on the IBC accounts is 70 to 75%. So though you may have an SR steel where you may recover 60 to 70% or 80% for that matter, but on an overall basis, banks have provided 70% on IBC accounts. And what we really like in the recent trends that you can see in some of these quarters is that all the banks actually have improved their provisioning coverage ratios very sharply.
Yes.
So the legacy related provisions which you were actually having every quarter because you had to improve your provisioning coverage ratio, that run rate will reduce going ahead.
Okay. Can you give us some color on what you're expecting by way of loan growth and margins?
Yeah, so loan growth is expected to be about 20% for the public sector, for the private sector banks, and about 20% for the private sector, and 10% for the public sector banks. So the overall system loan growth should be around 14 to 15%. If you look at the bifurcation here, it's going to be predominantly driven by retail. Retail is growing at 20%, 18 to 20%, and I think that would sustain. And the corporate loan growth would be somewhere in single-digit number, right? So the capex-led corporate loan growth will be absent, but then there are opportunities in the market in terms of NCLT refinancing, which can support some kind of a loan growth in the near term. And as far as margins are concerned, we do expect an improvement in margins despite the RBI regulations on, the change in linking the lending rates to the external benchmark. The reason why we do expect improvement in margins is because we are going to see a lower run rate of slippages. Therefore, you are going to have a lower interest reversal, and we will also have interest recoveries coming from some of these IBC accounts. So to that extent, margins have also hit a bottom, and going ahead, we do see an improvement in margins across the sector.
Okay. Can there be upside surprises in margins? Because it's quite possible that there is a bit of risk aversion towards mutual funds.
Correct.
The reverse financialization could happen towards banks?
Possible, but then, Lata, over the
course
of...
That's not part of your
It is, but then what we're arguing is the next 6 months looks pretty difficult in terms of getting an immediate upside in terms of margins. Because remember, deposit growth today is running at 9 to 10%, and loan growth is running at 15%. And, and this deposit growth is not going to come back anytime into the system till the elections get over. Typically, pre-elections, the currency in circulation goes up, and we have done this analysis for the last 3 to 4 elections, and you can see every time during the election time the currency in circulation goes up significantly. And also what happens is that the government is sucking out a lot of liquidity in the form of divestments, right? So that liquidity will take some time to come back into the system. Till March end, the government has to show a fiscal deficit number of 3.4%, so they're not going to spend that money. So it sits as balances on the balance sheet of Reserve Bank of India for the government to spend it and for that money to come back into the system and then flow in the form of a deposit growth is going to be easily a 4 to 5 month time lag. And in that process, the deposit growth being weak is definitely going to put pressure on margins in the near term.
Okay. Actually, my producer is repeatedly showing the list of stocks, probably because they want you to tell us what is the pecking order now.
Yeah, so the pecking order is ICICI. Again, we are corroborating the theme of reversal of the credit cost, and therefore ICICI really fits that picture very well. Then next, followed by that, we really like Yes Bank. Especially the fact that they have got now nil divergences gives a lot of credibility to their balance sheet. So Yes Bank will be our next pick. And the recent underperformance in IndusInd Bank, I think that also offers a very good opportunity, in my opinion, to enter into the stock. An ILFS is one mistake that they've done in 10 years. So I think we can give that benefit of doubt to the management, right?
Okay. So. Well, yes, I guess you're relieved that Yes Bank has got that certificate. You did place a lot of faith in them.
Yeah.
What about the mid-level banks? In the DCBs, in the RBLs, Federals, you don't want to extend your likes to that area?
Not exactly. So if you were to look at it, I'm not sure how many of them could be the next say an ICICI or an HDFC bank, right? So one of the biggest problems with some of these mid-level banks is the liabilities franchise. You buy a bank for its liabilities, not for its assets. You can easily grow your assets, set up DSAs and grow your asset book. But then the real challenge is to have that brand presence, to be in a position to mobilize your deposits. And that's where I think some of these mid-level banks don't do a great job. And the private sector banks, the large ones, have done a fantastic job, whether it is digital banking, leveraging of technology and stuff. So to that extent, while they may be good investment bets in the near term, to take a structural longer term call on them, I think they have to really do a lot amount of stuff for work on the liabilities franchise. For example, RBL, for that matter, it's so expensively valued, but on the liabilities front, the progress has been pretty unsatisfactory, right? So
okay, IDFC First Bank, no? You would wait for them
absolutely
to build.
The same issue, and the management themselves say that the ROE could be in double digits in 5 years' time. I think that's too much of hope, for which you're paying for. And I'm not willing to place a bet on them, to be honest. And
you would want to see liability before you buy
exactly.
Yeah. Okay. Now let me come to the NBFCs.
Yes.
Okay, before that, none of the PSU banks?
No. I'll be very honest. The challenge there is, though they are also leveraged to the normalization of credit cost story.
First, if you want liability, that's where you
They do have. But then, Lata, what exactly happens is that they don't have the capital. The capital provided by the government only suffices for providing for the bad assets and meet solvency norms. So you need capital for growth. So clearly, where are they going to get capital from? And then secondly, any capital infusion is going to happen at well below book value. So you as a minority shareholder gets heavily diluted. Plus, then I am not very convinced about the fact that the farm loan waiver issues are over. And plus, at the end of the day, from an investment standpoint, we need structural reforms in public sector banks. The government has been talking about ESOPs, lateral hiring. We still see musical chair being played in the public sector banks across, for time and again. So I just really don't have any conviction that there is a structural reform happening in these public sector banks.
No, there's no structural reform at all. There was only capital.
Invest in them?
Yes. Well, I still think that some of them have quality management. At least one of them would have. But let's see. I take your point about ROE and ROA being the final measure of how they do. I want to really come to the NBFCs. Sure. Will you pick anything from the rubble? The stock prices have fallen very steeply, barring, of course, the Bajaj twins. But would you buy any of the...
See, some of the larger, well-rated NBFCs are still pretty much okay. I think
that is what, Bajaj and HDFC, I guess.
That's right. And even LIC Housing Finance is fine. They have a very strong parent and promoter backing. The stock is really cheap. The way I look at it, Lata, is that what could be the end user asset quality? So if I were to take into account, for example, a guy like a Shriram's Transport Finance or Cholamandalam Investment Finance, the borrowers are not in a dire state, right? So they can still they can still repay the money. It's the lender which has the liquidity problem. So as long as the borrower is in a position to repay, that's fine. Now, where it could be a problem could be in terms of NBFCs which have financed the real estate sector, where obviously the borrowers could be in problem. Would I pick somebody of them? Definitely not. But would I pick a company like a Chola even at this level? Definitely yes, because the fundamentals of the company are pretty sound. It's got a solid promoter background, and the liquidity crisis will definitely offer you an opportunity to enter into the stock from a longer term perspective. So near term, next 6 to 12 months, there are going to be challenges.
Okay, and India Bulls?
Well, we do like. CRISIL doesn't necessarily give a AAA rating to every institution. There are only 6 or 7 institutions in India, NBFCs, which have got a AAA rating. And they have got solid liquidity management skills. So even in that sense, they really stand out pretty well. So I'm pretty okay even with India Bulls Housing Finance, to be honest.
Okay, well, just a word on the news that's flashing. This is not looking very good. That's Dr. Reddy's, where some observations have come on the Bachupalli plant. That's 10% down on that stock. We will have to get Ekta to come and explain to us what exactly Jeffries is telling us on Dr. Reddy's. This is 483 is the form in which the US FDA tells you the errors they have found in a plant, and that is 11 observations, 10% fall in the stock. We will attend to it in a minute. But when you think of medicines, you also think of insurance. Any of the stocks you like there?
Well, we'll do like ICICI.
You always found them expensive.
Yeah, that's right. But then valuations have corrected quite sharply. So we were always arguing that some of these valuations are really unsustainable. The valuations at which these insurance companies got listed. So Pru is pretty attractive at these valuations. And in fact, you should buy a company when it is at its cyclically low level, right? Okay. So obviously the markets have been weak. Growth has been weak. Pru has corrected. But fundamentally, the return on embedded value doesn't change much. It's still about 17 to 18%. So I do like Pru over the longer short term, considering where the valuations are.
Okay, Suresh, we will thank you on that note. Would have gone on, but it's just that Dr. Reddy's has fallen so much. It is just compelling your attention. 10% fall. And here's Ekta to tell us what the Jefferies report is saying. Ekta, very serious observations?
Well, you know, Lata, the important part is that Bachupalli is the most important facility for Dr. Reddy's at this point. 45% of their US sales currently comes from this facility, and they've received 11 observations for this particular plant, which was just inspected a couple of weeks ago. Now, I do have the 483, which I'm just trying to open, but as of now, we do have the Jefferies note, which is written on these particular 483s, and they have said that there are 4 observations which are basically repeat in nature. So that means that if in case there are 4 repeat observations, generally it takes a much more longer time for a company to resolve those observations, and the risk of an escalation to a warning letter or an import alert is greater. So the EPS impact on Dr. Reddy's would be much greater because they already have the Srikakulam API facility which is under warning letter. They already have another facility which is under warning letter which they are trying to resolve at this point in time. So if there is a third facility which they have to remediate, plus there is a third facility which could probably escalate, which is also one of their most important US facilities, then obviously is not going to bode well for Dr. Reddy's from an earnings point of view as well. So they have mentioned that the observations are around a lack of thorough investigations, written records lacking details, employees not being trained, and lack of infrastructure. So they have said that the remediation, given the type of observations they've seen, is going to take time and is going to likely require re-inspection. In such a case, when there are these kind of observations which come through, even if there is no sort of immediate escalation that you see, the problem is that the approval starts stopping from that facility. So approvals slow down, and the USFDA obviously becomes much more diligent, and hence that's when you see the impact coming in on earnings as well for a company such as Dr. Reddy's. So this would probably remember that, just to give you a bit of a background on this particular facility, it's a formulations plant. It was last inspected in April 2017. At that point in time also, Dr. Reddy's had received 11 observations. They had managed to successfully solve those 11 observations. They had received an EIR from the USFDA in December of 2017. But after that, this is the first CGMP re-inspection which has taken place. And out of that, they've found 4 repeat observations which have not been solved from the previous time. So that obviously doesn't bode well.
All right. Do stay on, Ekta. We'll try and connect with some analysts as well to check out, whether there is an immediate cut in earnings or whether they will wait to see how things pan out. It's their biggest plant. As well, the chances are that further permissions are not going to come easily for products from that plant, and therefore revenues are going to be affected sooner rather than later. So the stock is reacting, but okay, there's a little bit of recovery from that 10% cut to now an 8.25% cut. We'll try and get more analysts to tell us whether they've already calculated what kind of an earnings hit this might mean. At the moment, it's a stock price hit.